The S&P 500 is up 6% this year and on the verge of doubling since the bear market low back in March of 2009. Unemployment rate seems to be falling. Consumer spending appears to be picking up, and the S&P 500 earnings are poised to hit new records. It's all too good to be true. Chris Hyzy is the Chief Investment Officer of U.S. Trust, a division of Bank of America that oversees about $200 billion in assets. He's here in studio. So, Chris, is the momentum going to continue, or is it too good to be true?
It really depends on your time frame, but since you asked the question, yes, the momentum should continue. You're looking out 6 months, 12 months, on a rolling 3-year basis, on a rolling 10-year basis. We think the momentum is still there. There's a lot of good things going on that simply are not bubbling up to the investor that has yet to come back into the markets.
So we were looking at some of the internals, though, and noticing such light volume. We talk about that virtually every day here. How is that skewing market moves, and how are you accounting for that?
The light volume ends up exacerbating certain trends, both up and down. I think what's happening right now is you see individual purchases of indexation, ETFs, things like that, instead of the individual movements of different shares of companies that are causing volume to be lower than what we would normally see in past cycles. We think that's a good thing, actually. That just means that there's still a wall of worry out there. They're anchoring positions in certain ETFs in terms of the mutual fund managers instead of owning individual companies that they feel comfortable with. That should change once hiring starts to be more transparent. We saw one good month. We expect that to continue and accelerate through the rest of the year.
The S&P is trading at, according to Bloomberg data, about 14 times estimated 2011 earnings.
Yeah.
So that maybe is an argument not to sell, but is it also an argument to buy?
You have to look at 2012 now. So you have to start looking. As soon as we start to hit the summer months, you'll start to see portfolio managers look towards 2012 earnings, another 7-8% increase off of 2011. So about $101, $102 on the S&P with about a 15.5, 16 multiple. That gets you close to 1550, 1600 by the end of 2012, which is what our target is.
So are you arguing for more allocation towards outside of equities, commodities and the like, given the kind of spikes that we've seen in mining stocks and metals and in oil?
Well, certainly from a strategic basis, yes. Now, to use jargon on a tactical basis, they're a little pricey right now. Obviously, they've made significant runs. Everyone talks about oil, but you could talk about the entire commodity chain, including many soft commodities that have simply gone up significantly since October of last year. For the new money, we would pause. For new money coming in, repositioning portfolios in the summer months, we think you'll see better prices. But certainly for strategic 3-year plus long-term investing, yes, absolutely, reflationary assets are the place to be.
Oh, one of the arguments behind why we've seen such a run-up in that space are easy money flows. ECB, if we do, as expected, see them, get a little bit more hawkish there, tighten up policy, does it pull us back on the commodity front?
That's a good point. The interesting point about this, the one country that's tightening the most, both in their reserve required ratios as well as their interest rates, is China. But yet commodities are still heading higher. So if the ECB actually hikes, they're less of a buyer overall of all of that versus China. So actually the impact, if you see commodities drop because of it, it's a buying opportunity.
And Chris, you're really saying this is a global bull market?
It's a global bull market. We call it a marathon. When you take a look at the last 3 structural changes that we've seen since the 1930s. We had a massive structural change in this last few years, really going back to late 07 till now. It's basically a massive deleveraging event. You're going to get an expansion of the balance sheet overseas. You'll get a shrinking of the balance sheet in the rich world. This will take at least 10 years to work itself out. It's the good news, actually. Global growth is going to be rising 4.5% plus through this. There's going to be some disparate central bank policies around the world that'll cause some volatility.
We're about to see that, right?
We're about
with the ECB.
To see that. Absolutely. ECB doing one thing, the central bank in the United States doing another, the Chinese central bank doing something else, and then around the world, and as away we go.
How does it get derailed, though? I mean, as you see that divergence in central bank policy, is there a risk here with the United States perhaps not following the more hawkish route?
Actually, the funny thing about this is go back to 07. The Chinese first put out $1 trillion package out there, fiscal package. Now they've been the one that's been tightening. ECB is not really sure what to do given the austerity measures, but yet higher oil prices, et cetera. They're probably going to tap on the brakes.
They have to fight inflation.
They have to fight inflation. Meanwhile, the Fed is sitting there on the back of a massive bond bond buying program right now, which is basically putting them in a really tough spot. High oil prices, bond buying program going away. Hiring is the key here. Hiring moves forward like we expect, 250,000 net new jobs on average per month for the rest of the year, would force the Fed to come quicker and start to tighten policy, probably early next year.
Early next year is when you're expecting it. Isn't there still that sugar high of sorts if you're talking about unemployment, that key fundamental to it all really not being as vibrant? Yes, we're showing signs of improvement, but we're still hearing from corporate America that they're being quite cautious with hiring.
Yeah, corporate America, very healthy, balance sheet healthy. This is an entire balance sheet equation going on right now, which is a good thing. It's a structural change, which means it's going to take them longer to do what they did before when the U.S. consumer powered everything. Now with somebody else outside this country powering everything, there's a little bit of a latency going on. We think that elongates the whole cycle, which is why we call it a global bull marathon, not a race.
A marathon. Thank you very much, Chris.
Sure.